Alrighty, folks, this is the 12th video of the Maybe series and the 20th under accounting. And in this video, we're going to be talking about stock-based compensation. So stock-based compensation is actually relatively similar to regular compensation on our income statement, right? So when we think about salaries, right, these fall under either like operating expenses, some people call it SG&A. At the end of the day, the classification doesn't really matter too much in terms of the accounting, right? And these are paid in cash, right? So these show up on our income statement as one of these line items, and they're paid in cash. For stock-based compensation, essentially what happens is that a company issues stock and they dilute their current shareholders, but we're still going to see it on our income statement. So instead of cash, they pay stock, but it is still an expense on the income statement, right? But one thing to keep in mind is that, sure, it's going to be an expense on the income statement, but because we're paying it in stock, we're going to have to do some adjustments on the cash flow statement. So let's look at an example, and that will make it a bit clearer, right? So let's say that we have $100 worth of stock-based compensation, 25% as the tax rate, right? So let's write out our statements here, our balance sheet, our cash flow statement, and I'll kind of write out a pretty extensive income statement here so that you guys can kind of see where everything fits, right? And I'm kind of adding these line items one by one because I feel like if I just threw everything all at once, then there's a ton of line items that you guys don't really understand the kind of thought process behind, right? So we start off on our revenue like we always do. We subtract out our cost of goods sold. That gives us our gross profit. From here, we subtract out our operating expenses normally, right? But we're also going to subtract out our stock-based compensation at this point in time. That gives us our EBIT. And then here we have all the adjustments that we talked about on EBIT, right? We have our interest expense, we have our gain slash loss on a sale, right? We also have our goodwill impairment, right? And that gets us to our earnings before taxes. Then we're going to calculate out our taxes, and then that's going to give us our net income, right? So overall, we can kind of see where stock-based compensation sits on the income statement. So if we have $100 worth of stock-based compensation as an expense on our income statement, what that's going to do is adjust down our EBIT by 100. It's going to adjust down our pre-tax income by 100, right? Because none of these other items changed. Now it is going to affect our taxes, right? So our net income is going to be down by 75 instead of the full 100 because we had that tax savings, right? That flows through to our cash flow statement, right? So on our cash flow statement, we have net income that is down by 75. But remember, this stock-based compensation, was this a cash payment that we made? No, right? Stock-based compensation is just stock. We just issued more stock. So because of that, we're going to add back the stock-based compensation amount, right? Because to say that our cash went down by 75, that's not accurate. So we have to add back the full stock-based compensation amount. And here's a particular kind of accounting rule or like a tax code rule, right? And that is that stock-based compensation does not give you a tax benefit until it is exercised, right? So, i.e., this means that stock-based compensation gives us a future tax benefit. And what's another name for a future tax benefit? That's our deferred tax assets, right? So stock-based compensation does not lead to us having more on cash as as another expense might have. It essentially, or as like depreciation might have, but essentially it gives us a deferred tax asset, right? So if our deferred tax asset goes up, right, if our assets go up, that's a use of cash, meaning that our cash goes down, right? So we're going to have a minus 25 here. So overall, our change in cash is 0. So we move on to our balance sheet. We have no change in our cash. However, our deferred tax asset did increase by 25, and that's under assets, right? Now, in terms of our liabilities, did those change at all? Nope. In terms of our shareholders' equity, and this is where we have to be careful, right? Because normally we just pull this minus 75, right? And we call it a day. However, in stock-based compensation, we issued $100 more of stock. So we have to add in that additional 100 to give us a plus 25 to our shareholders' equity overall. So the two main key areas are number one, stock-based compensation leads to a future tax benefit, which is a deferred tax asset, right? And that's going to adjust our cash down. And the second is that stock-based compensation, we have to add that in to our shareholders' equity. So make sure don't forget to add that into your shareholders' equity. So these are the two main points with stock-based compensation in terms of how it's unique from a couple of other changes that we might see on the three statements. So yeah, as long as you keep those in mind, hopefully it should be relatively simple. And yeah, I hope that's been helpful, and we'll hop into the next one.